So next we're going to talk about how to account for dividends. And again, a corporation does not by law have to issue dividends, but you understand that if they don't, people will get upset, sell their stock, prices drop, flood the market. So there's two types of dividends, and first thing we're going to talk about is cash dividend. Cash dividend is what everybody likes to have. It's basically a check. You're going to get a check. But if you're the stockholder and you actually get a cash dividend check, you have to report this on your yearly taxes as income. However, let's talk about when a company is going to issue a dividend. Three important things have to happen. First of all, I have to have enough cash. That's very, very important. I also have to have enough money in my retained earnings in order to do that. And finally, there has to be a formal action by the board of directors. Okay, that's really important too. That has to happen. But the retained earnings, we'll talk about that. So if I don't have enough in my retained earnings to pay out a dividend, I'm not going to be paying out a dividend. So I always want to make sure I keep my retained earnings up there. Okay, there are three important dates that you need to know about when issuing cash dividends or stock dividends. Stock dividends are the other ones we're going to talk about. And here are the three important dates, and let me talk about these. So the first one's called a date of declaration. The second one's called a date of record, and then finally a date of payment. So let's on the next slides, I'm going to tell you what needs to be done. There will be journal entries attached to these dates. So on the date of declaration is really the date the board of directors gets together and decides to authorize the dividend. On that date, on the first date of declaration, you will need a journal entry to declare your dividends. Okay? That's the first date of declaration. The next one's called date of record. Date of record is the date in which the corporation will determine who's going to get the dividend. So if you own the stock on the date of record, then you would be getting dividends. Okay? And so there is no journal entry required for this whatsoever. No journal entry for date of record. It's just who owns the stock on that date will get dividends. Finally is date of payment. This is the actual date that the dividends will be paid. And you will need a journal entry for this date. Okay? So let's look at an example. We have Hyber Corporation on October 1st. October 1st, the board of directors declares a cash dividend with a date of record of November 10th and a date of payment of December 2nd. And here's their preferred stock. They have 5,000 shares outstanding. The stock is $100 par, which is just the value assigned. They're going to issue a $2.50 dividend per share. And common stock has 100,000 shares outstanding at a $10 par. Again, this is just the value of it. They're going to issue 30 cents per share. So remember the three different types of stocks. Authorized, issued, and outstanding. I only pay dividends to outstanding shares. So I'm going to pay out a total of $42,500. Here's how it's going to be broken down. So let's talk about the journal entry. October 1st, here's my journal entry right here. This is putting it on the books as declaring the dividend. Cash dividends is debited. Cash dividends payable is credited. So this is the dividends that will take away from your retained earnings. November 10th, date of record. Here's the date of record. No journal entries required. That's if you own the stock on this date, you're going to be paid on the 2nd. Here's the date of payment. And here's the journal entry. I actually sent money out. And I debit my cash dividends payable. So this is about cash dividends. My next video will be stock dividends.